Welcome back to book club. We are going to jump back into part 2, building indicators from the ground up, chapter 6, reading basic bars and how to pounce on opportunities. All right, so we left off on putting it all together using bars to identify trends. So we're gonna jump right in right there. All right, get comfy, let's jump in. All right. The relationship of the bar components to one another contains useful information, and even more information comes from the components across a series of bars. In fact, sometimes you get so much information that you risk information overload. As I discussed in chapter 2, the law of supply and demand states that for every security, you can find some price that persuades buyers to buy it or owners to part with it. After a price is established through the execution of a real cash trade, traders have a baseline from which to track all ensuing prices. Any transaction may occur at a random price, but not every transaction can occur randomly, or the market in that security would collapse. The central observation of technical analysis is that the price bar embodies all the supply-demand dynamics of the day, and that a series of bars on a chart shows the evolution of the supply-demand dynamics over time. Some percentages of the time, the evolution is visible in the form of a trend. In this section, I describe how to use combinations of bars to identify a trend. Identifying an uptrend. The textbook perfect uptrend is a series of up day bars, close higher than the close the day before, that have higher highs and higher lows and a majority of the bars. A series of higher highs implies the fourth factor, close above the open. Higher high. When the high today is higher than the high yesterday, or higher than the high of the past few days, you have a higher high. Higher highs refer to visible peaks, not a higher high every single day. A series of higher highs signals bullish sentiment. Higher lows. You qualify the higher high by the additional confirming condition of higher lows. Now you have two pieces of evidence that bulls outnumber bears. A series of higher highs together with higher lows hints that a trend is forming. After 2 days, you aren't yet sure what is happening, but you're starting to get excited. After all, your goal in identifying a trend is to buy near the beginning of the trend. Your key assumption is that a trend, once formed, will continue. If you have 2 higher highs with 2 higher lows, can you assume that day 3 will also deliver a higher high and a higher low? Not necessarily. Alas, prices don't move in straight lines. You often see a series of 2 or 3 higher highs interrupted by 1 or 2 lower highs. This can happen for several reasons. Traders already in the security are taking an early profit. The market is reconsidering whether the new high is really justified. The higher highs were just a random accident. You seldom see an unbroken series of higher highs on every single day. Go back to figure 6-2. You see a series of days on which the close is higher than the close the day before. At the same time, the price is making a fresh high nearly every day, but not every day without fail. See the bar marked day 4. On that day, the close was higher than the open and the low was higher than the day before. But the high of the day wasn't higher than the day before. What does that mean? Remember, you don't know yet what day 5 is going to bring at the time you're looking at this chart. Most analysts tell you not to worry about this particular configuration of bars. It's an uptrend, all right. And you know this because you have an unbroken series of higher lows. Day 4 is a disappointment. It doesn't deliver a higher high, but the low is higher than all the previous lows. By considering the additional factor of higher lows, you confirm that the probability is probably pretty good at getting a higher high, if not also a higher close on day 5. Pinpointing a downtrend. A downtrend is a series of down day bars, a close lower than the day before, characterized by lower lows and lower highs, and a preponderance of the bars. Moreover, the lower lows tend to lead to the close coming in below the open, although not in every case. Look at the down days in figure 6-3. After the first day, each of these bars has a close lower than the close the day before. Day 3 has the same high as the day before, but a lower low. On day 3, you start to get the idea that this may be the beginning of a downtrend. When identifying a downtrend, a series of lower highs is a good confirming indicator to the series of lower lows. The same psychology applies as when an uptrend starts, only in reverse. Sellers see that the new lows are occurring. Somebody must know something negative about the security. Traders aren't willing to hold a falling asset, and they unload it at ever lower prices. Okay, overcoming murky bar waters. Reading bar charts isn't always a clear-cut process. In bar terms, a trend has two identifiers: a series of higher highs or lower lows, and a series of up days or down days. Technical analysis doesn't offer a hard and fast rule on which identifier is more important. Traditional technical analysis emphasizes that you need higher lows to confirm the higher highs in an uptrend, but candlestick analysis, which I cover in chapter 8, says that the position of the close trumps every other factor, including a new high or new low. Difficult and confusing bar configurations arising from strange placement of highs and lows is usually overcome by the candlestick notation method. The high and low appear on the bar, but only as a barely visible skinny little line at the top or bottom of the main body of the bar, which features the open and close. In fact, in the candlestick-based Ichimoku indicators, the moving averages are calculated using the midpoint of the open and close, not the close alone as in the standard bar analysis and most indicators. This makes sense from the viewpoint of trying to identify the main thrust of sentiment by the majority of participants in a security. After all, a high or low may represent an extreme of sentiment or a random event. The midpoint of the bar is much closer to the concept of reversion to the mean or central tendency in trending markets. If you usually prefer standard bars but find yourself confused by a particular set of bars, toggle your software to show the bars in candlestick format. You may get a flash of insight. Paying heed to bar series. Paying heed to bar series. Usually a series of higher highs with higher lows or a series of lower lows with lower highs does mean that the trend is emerging, even if the close doesn't yet confirm. Higher highs imply higher closes aren't far behind as the logical outcome, just as lower closes are the eventual logical outcome of a series of lower lows. Market players start wondering why other traders are taking the price to new highs or lows. What do they know that you don't? New highs and lows arouse emotions. A sufficiently larger number of new highs triggers greed. Better buy now so you don't miss out, even if you don't know why the high is occurring. Alternatively, new lows scare just enough traders that they sell their positions even in the absence of any fresh news that would justify it. Okay. Sometimes you get higher closes without getting a preponderance of higher highs. Pay attention anyway because new highs may start to appear. These new highs may happen solely because so many people are aware of the meaning of up days and down days. In other words, so many people look at technical indicators, and a series of up days or down days is a basic indicator that they anticipate higher highs or lower lows. By acting on the expectation, buying or selling ahead of the actual appearance of a higher high or lower low, they make it happen. You'll observe this type of self-fulfilling prophecy often in technical analysis. If it's not already provided, turn on the feature in your charting software that graphically differentiates between up days and down days, white or green for up and black or red for down. It takes no practice to see where a trend is interpreted by bars that don't qualify. Knowing when bar reading doesn't work. Some price series are unreadable. You can't figure out what the market is thinking because the market is changing in the mind several times a day from day to day. Figure 6-4 is such a chart. The series of gray up days is a minor uptrend, and the following series of black down days is a minor downtrend. But then things fall apart. You see higher highs followed by lower lows, and no consistency in the placement of the close, up day or down day. What do you do in a case like this? Nothing, at least not at least not anything based on interpretation of the bars. When bars are messy, and as in figure 6-4, the probability of picking the right direction up or down is very low. You'd just be guessing. And although you have to accept imperfection and a certain amount of ambiguity in bars and bar chart analysis, the whole purpose of technical analysis is to obtain a higher probability of making the right decision. Guessing defeats the purpose. All right, we're gonna end it there, and I will see you next time. Thank you for joining.